Hey everyone, so today we're going to be going over broader market analysis, and there was a ton of information that came out this past week, whether we want to talk about First Republic failing, the Fed rate hikes, the geopolitical risks, the tensions in Russia rising with drone strikes, whatever the case may be. I think there's really two main drivers, and those two main drivers are the Fed and the FOMC meeting that happened, and then Apple's earnings, right? And why would I say a company's earnings, right? The reason is because this is the largest name, right? And they primarily get their revenue from where? Sales of products to consumers, such as the iPhone, the iMac, the iPad, etc. So Apple having really good numbers would, or relative to estimates, might signal, hey, the soft landing could still happen. And I think that's what's happening in this past week. So what we saw on Wednesday was the Fed hiked by another 25 basis points. It was unanimous. And Powell essentially said that they don't expect a recession, right? The soft landing narrative is starting to come back into play. And the market appears to be buying it with Apple's earnings. As we can see here, taking that information and bringing it over here, we can see that market volatility has fallen substantially in the past couple of days, almost back down again to the all-time lows on the SPX. We are in extremely cheap volatility levels in terms of just standard absolute terms. Now, in relative terms, right, this is different. We actually saw the premium begin to start kick up over the past couple of weeks. It's since come back down a bit, but the premium is still starting to juice up a bit. And the reason that I say that this might not be a particular inefficiency, this more might less be a signal, is because of the context of the product we're talking about. We're talking about the S&P 500, right? The most efficient equity space, product that there is, right? There is no more efficient market than SPX, right? So having this premium kick out could be a signal that future volatility is most likely coming, right? And this would make sense. I mean, as we know, volatility oscillates, it is not it doesn't trend, it mean reverts, as we can see. Obviously, I assume most people know that. So with that being said, it's probably important, just like it was like a month ago, to really be looking right now at positions that have lower betas to the overall market. And you want to also probably make sure and just double check that the premium is truly compensational, because if we get future market volatility, for example, what would happen to your particular position? Would your position be more or less exposed to what's going on? Is it going to amplify? Are there like two triggers, so to speak? So you have the overall market volatility, which would create, more volatility on whatever stock you're trading or ETF. But then whatever could be a risk factor is also a fundamental driver, right? So for example, let's say like you were a grocery store company, right? And let's say it was extremely exposed to market volatility. And let's say you thought one of the risks in the future was, egg prices skyrocketing again and not being able to get eggs, right? Now, let's say that happened, right? You would get hit from the market volatility being spooked by that, but you also would get hit because that would fundamentally affect the business that you're trading. So, just thought I'd make that quick point. Besides that, guys, there's a couple other really interesting things going on right now. Taking a look at oil real quick to wrap up. I always like looking at oil because oil really gives a signal of, what is going on in the real economy, so to speak, where there is, you need oil to obviously make diesel products, to make, refined products, which then get used in the world's economy. So I always like looking at oil from that perspective. We have seen volatility levels come back down on oil over the past couple of days, and I really think that what this is just being driven by is it's more of a supply side ordeal. I don't really think it's a demand side. We've seen rig counts drop past couple of weeks. We have seen inventories continue to draw, and I think that that is really where it's coming into play. Last thing I'm going to leave you guys with is a really interesting tool. It's the CME Fed Rate Watch tool. It basically takes the Fed futures and calculates the rate hike probability or cuts. Currently, what we're seeing in June is we are seeing a pause is most likely expected. And then in July, we have a 36% chance of cuts. And in September, at that point, we have over a 70% chance in cuts. So, guys, that is all I have for this one. The link for this will be attached in the email, and I will see you guys in the next one. Have a great weekend.